Hey, welcome back to our channel. In this video, we are going to provide tips and tricks on how to save thousands of dollars in interest and how to keep your mortgage payment as low as possible. Many don't know that when you first buy a home and you place a down payment of less than 20%, that is actually called an insured mortgage. Now, let's just say time goes by, you are ready to leave your current lender. Maybe you're not happy with your current lender, or you want to go to a different lender with a different mortgage product, and also you want to save money, you want to get a lower rate. Well, if you previously bought a home, put less than 20% down, you have an insured rate. And insured mortgage rates are actually the cheapest rates in the market because you're paying a default insurance premium and there's no risk to the lender. If you stop paying your mortgage, the lender will simply go to the insurer and recoup their funds back. So there's ultimately no risk to the lender. This is why when placing a down payment of less than 20% insured mortgage, this is why rates are lower. Now let's fast forward a few years. You want to leave your lender and you want to take advantage of the lowest rates. Well, if you transfer your current mortgage product or rate or product to a different lender, and you could actually still keep an insured mortgage rate. Yes, you heard me correctly. You could actually still take advantage of insured mortgage rates if you're moving your mortgage over. Now, you might be wondering, well, Parm, my value actually has gone up on my property quite a bit. I bought my property for $500,000. Now it's worth $700,000. So technically, I don't have an insured mortgage, but you actually do because you originally paid for the insurance premium. Now that you are switching over, even though your property value has gone up, or maybe you paid a large portion of your mortgage principal balance down, you could actually still take advantage of mortgage insurance rates or insured rates with the new lender. And this is very beneficial because many don't know this and they end up switching to a higher rate, maybe an uninsured rate. And then they end up paying a higher mortgage payment and a lot of interest over the next few years of their new mortgage. Now you may be wondering, well, if I could still get insured rates again for my new mortgage, can I actually transfer my mortgage insurance over? And the answer is yes. You actually don't need to pay another set of a mortgage insurance premiums. And be very careful of this. Many don't know this and they end up paying two sets of mortgage insurance premiums, which is very expensive. Imagine you paid $15,000 the first time and then another $15,000 again. That's $30,000 out of your pocket, out of your property equity potentially, and it's going down the drain. So you can actually port your mortgage insurance over. Another thing is, if you are, let's say, moving from your current lender to the new lender, and you want to take advantage of insured rates, you could actually still, with some lenders, obtain a home equity line of credit. So you're keeping everything exactly the same. You're simply moving over to a new lender. You want to take advantage of insured rates, but at the same time, you want to pull some equity out of your home because your value actually has gone up out of your home. Well, some lenders will still allow you and offer you insured mortgage rates and add a home equity line of credit versus you refinancing your home mortgage, getting refinance rates which are higher than insured rates. So this is very, very important, and this is only available for some particular lenders. Now, when switching over, there are sometimes costs involved, such as a discharge fee that your current lender will charge you. There's usually no appraisal fees as well, but if there is an appraisal fee, or let's say a new set of legal fees, your new lender should cover this during a switch or transfer transaction. Now, if for some reason the costs aren't being covered by the new lender and you have to pay these out of your pocket, the new lender will actually allow you to capitalize and add up to $3,000 of those costs onto the new mortgage. We always recommend to our clients, if you have the money available, pay that out of your pocket because you don't want to increase your mortgage amount further, and at the same time, you don't want to pay interest on the extra $1,000, $2,000, or $3,000 that you may be adding. Again, it's always best to do a cost analysis and see if that cash flow is available, but most of the time it is. Well, thanks for tuning in. I hope this video was valuable to you and saved you a ton of money in interest. Don't forget to like, share, comment, subscribe, and see you at our next video.